16th with our latest client update. We want to give you our take of what our investment committee is thinking about for 2009. And today I want to introduce to you Rodger. He's one of our newest senior advisors at the consulate. He's also a key member of the investment committee. Rodger, there's a lot of liquidity that's been developed in the world, and that's one of the reasons why we're going to start becoming slightly bullish in 2009.
And appropriately so, Drew. I think that the liquidity, although that sword cuts both ways, that is, it can be positive and negative, was a necessary evil for the markets and for economies of the world at this time. And it does provide a significant amount of investing opportunity for us at the moment. We'd have to add, though, we're still concerned about volatility in the market. We're going to add positions to portfolios, but expect it to be, as we say here, a gut-wrenching ride.
Yeah, you know, some of our clients might not understand when I say liquidity, what we're referring to, and I like to explain it to, be something similar to air going into a balloon, that an economy inflates with money, liquidity, money that's being printed by the Federal Reserve and also by bank credit. And those are two things that we've seen lately change. Why don't you give us a little update as to why we're seeing that change?
Well, the significant change is that, for instance, in the United States, we've grown our money supply, or the amount of liquidity, by about 12% per year.
That's higher than normal.
Higher than normal, over twice as much as normal. And that's the good news. The bad news is that, to use your balloon analogy, if we blow the balloon up and add too much liquidity to the system, it can ignite inflation. And as you know, in investment committee, we've talked about that being one of the negative outcomes longer term as a result of all of this liquidity being added to the markets and the economies.
And that's why when we're going to start adding equity positions now, we're going to be focusing on commodities, because historically, when a government introduces excess liquidity by some form of non-market force, in other words, it's not like the economy is creating the liquidity, it's because it's being productive, it's because government is just kind of creating this money. Commodities have been a beneficiary of that typically.
Indeed. Precious metals, industrial commodities, oil and gas, energy commodities, as well as agricultural commodities.
That's one that you've done a lot of homework on, is the agricultural side.
We think that the supply-demand characteristics of agricultural commodities and commodities in general favor long-term capital appreciation, and the inflation side of that equation just underpins that investment that we've made.
Also, the excess liquidity will go where it's treated best. In other words, the government creates this money and they have a purpose that they want to see it go to, but money will always disappear to where it's treated best. And in our opinion, the greatest opportunity for money right now is in Asia. In China, Taiwan, Korea.
We continue to target Asia, especially with equity investments. We find the Asian economies to be very efficient, but also not bound up by the overgrowth and overcapacity of the North American economies and the economies.
Right.
So we expect to continue to emphasize Asia as time goes on, equity holdings.
The news, though, is that there are many banks that are in trouble today. America, $139 billion bailout. But when you see that happening and the government willing to step in and say, "Don't worry, we're going to pick the tab," you basically are taking away systemic risk from the general free market and taking it all internally to the government, which is why we believe that there's a disaster waiting to happen, but it's now put off the day of reckoning for a week, a year, 2 years, 10 years. Right now, I would say it's probably a few years off as opposed to a few weeks off.
Right. Unfortunately, the government didn't feel the opportunity was there to allow businesses to fail. And so what's happened is the government's pumped in liquidity, backed up these institutions, banks in particular, and have labeled them too big to fail. And therefore, this cleansing effect of some of those businesses hasn't been, and as you say, will defer the inevitable.
About 2 or 3 months ago, when we put out one of our updates, probably the most bearish we were when we said, I think we're going to be pulling out. We're going to be pulling out in a lot of accounts. We're going down significantly in our equity exposure. It turned out to be about where we are right now. Now, some investments were sold actually on the day of the bottom of the market. And, you could look back and say, why did you guys pull out at that time? And if you knew what we knew, you would have been hiding your money in the mattress because there was really systemic risk being that the whole economic system could have just collapsed. And you had a complete freezing of the credit markets. You had money supply that was barely growing, and if it was growing, it was growing sporadically. And you had Citigroup was going under. You knew it was going under. You had the markets were touching on their 10-year low. And historically, the type of economic situation we were in normally would see a market go down by 70 to 90%, and we were only down 35 to 40% at that time.
So in terms of managing portfolios, we had very little choice but to attempt to achieve our preservation of capital objective, and in doing so, needed to pull out or retrench back from the markets. Now, as we roll the clock forward, the situation we think is improved. I don't know that I would call it much improved.
But it's definitely, liquidity is growing freer now. It's moving in a much more logical pattern. It's not sporadic growth of money. Bank lending has improved. One of the things we watch is the spread between the Treasury bill